Chery is an entrepreneur, an author, a blogger, a mom of two kids. Her accounting practice specializes in helping real estate investors reach their investment goals. Chery started her real estate investment journey over 10 years ago. She started by buying one student rental in her own name, then became two more in the same year. Now she co-owns multiple properties with her husband. Chery graduated with the honor roll on the Chartered Accountant Uniform Final Exam Top 10 in Ontario in Top 50 in all of Canada. She was named Top 50 Women in Accounting globally in 2018. She has worked with hundreds of real estate investors and have met over 1,000 of them. Chery is in high demand as a public speaker for her tax knowledge. Through her blog, she has been inspiring others to take charge of their lives and take action. Chery is a best-selling author on Amazon for her book called The Complete Taxation Guide to Canadian Real Estate Investing. She can be reached via her website at realestatetaxtips.ca. Prior to a life of law, Sean had an interesting career as a private investigator, which eventually led him to becoming the youngest hearings officer at the Canada Border Services Agency, where Sean represented the Ministry of Public Safety and Emergency Preparedness in immigration proceedings. At this point, Sean realized the study of law was the life direction he wanted to take. After specializing in Eastern European organized crime proceedings and earning his law degree, Sean decided to continue his love of learning and earn his Master's of Business Administration from the University of Windsor. It is no surprise that Sean's extracurricular activities would be just as active as his educational background. Sean is a real estate entrepreneur with his own small real estate company and an active real estate investor in the REI world. When he's not participating in REI, a real estate investing community, Sean enjoys time with his partner Amber and his third four-legged friend Pluto, and he also competitively curls and plays hockey, golf, and softball. So take it away, guys.
Cool. That's awesome. Great introduction. So Sean, do you want to get started or do you want me to get started?
Well, first of all, Sam, thank you for having both of us and for those lovely introductions. It's great to be on here, and I see our attendee list is growing by the second. So thank you, everybody who's chimed in, both on Zoom and live on Facebook. The three of us are very happy that you decided to join us today in your afternoon, probably just as you're coming off work or perhaps enjoying an after work libation. So thank you for joining us. So Sam, would you like me to introduce today's topic, or would you like to do that?
Yeah, absolutely. So we're speaking about real estate investing, mainly though capital gains, minimizing understanding capital gains in investment property and tenanted properties. So Sean, if you could dive a little bit deeper for our audience, that'd be great.
Sure. So if anyone out there is considering on selling their property, their investment property, there are a number of items that it's important to consider before you take the plunge. And these aren't necessarily items that should dissuade you from selling, but they are certainly matters that you'll want to keep in mind, that you'll want to consult with your power team about, your realtor, your tax advisor, your lawyer, and it just so happens you have three of them on this call today. So, why don't we start a little bit with capital gains? So, Chery, when I hear my clients talk to me about capital gains, they get this fear, like it's some sort of, it's a bad thing. And of course, no one likes paying tax. But why don't you tell us a little bit about why maybe that might not be such a bad thing after all?
Yes, capital gain tax is definitely not a bad thing. Is it okay if I share my prepared slide here right now? Okay, so I have done pre-prepared some sample slides to explain the tax implication on sale of rental property. So I'm just going to quickly share this. Can everyone see it? Okay, awesome. So when you sell rental property, or when you decide to get into a rental property, it's obviously whatever you do in Canada, you are required, you should always look into the tax implication before you get started. The reason is because the tax man always has his hand in your back pocket. He's an invisible business partner that you have. And we live in a great country. We get a lot of things here that in the other side of the world don't have, but we also pay fair share of taxes. Not that we are not paying, we just want to minimize the amounts that we need to pay. The reason why a lot of people are choosing real estate over other type of investment is because when you sell real estate, for the most part, when you sell, the profit generated is considered something called capital gain, but it isn't always the case. For some specific investment strategies, you may or may not be able to, the profit that you make is not necessarily considered capital gain. So let's just step back and look at what capital gain means and what income means. Not all property sale is considered capital gain. Capital gain on its own, if you make some income and the income, or if you make some profit from sale of a property, and that profit is considered capital gain, 50% of the money that you make is considered taxable. But if that transaction on its own is not capital gain, it's considered income, 100% is taxable. Now, just use a quick example to explain. If you make $100,000 on sale of a property, if the sale transaction on its own is considered as capital gain, only $50,000 is taxable. Even at the highest marginal tax rate, around 50%, you would only pay $25,000 of tax. But if a transaction is considered on the income side, 100% of it is taxable. So the entire $100,000 is taxable, and therefore you would pay $50,000 of tax at the highest marginal tax rate. And that's the reason why it's always beneficial to have something, to invest in something that will generate capital gain, because only 50% of it is added to your income. Now, so some example of strategies including in real estate that are considered on the income side, and the profit that you make would be 100% taxable. It's like assignment deals, flips, land development, wholesaling, some rent-to-own deals. They are all considered on the accounts of income, and all the profit that you make is 100% taxable. So it's not as beneficial. But on the other hand, if you are doing any type of long-term buy and hold that you generate rental income, that also includes long-term buy and hold for rental, for short-term rental. I know I'm using long-term and short-term alternatively, but Airbnb is just one type of long-term rental. You can generate a short-term rental income. I guess the churn is a lot faster, but essentially you're still using it to generate rental income. So if you have any type of long-term buy and hold, typically the sale of the property is on account of capital. In tax term, on account of capital, the profit that you make is considered capital gain, and it's only 50% taxable. So you stepping back, if you have a job, you have a full-time job, you're looking into investing in real estate, your job income making $100,000, the entire $100,000 is taxable. But if you sell a property and make $100,000, only 50% is taxable. And therefore, it is extremely tax efficient to earn capital gain, to make any sort of capital gain. I don't know if that kind of answered the questions. I want to go back to a little bit of interactive instead of me just presenting the whole way. Sean. Or Sam, sorry, Sam.
Yeah, and feel free in the chat to throw any questions you have. I'll help moderate some of the questions here. As well as if you'd like to book a call with any of these two or myself, we can definitely look into that as well and get you our calendar links. Any questions as well? We do have some questions that I have as well from previous people we've spoken to. See if I can grab some of those. So how does capital gain affect me if I've purchased a new construction condo or property and assigning the purchase contract to a new purchaser before closing? I believe you answered that. Can you just dive a little bit on that one?
So as you're talking specifically about pre-construction deal. Yeah, pre-construction assignment sale is now depending on your particular situation, because there's a change of law in the most recent federal budget. So they changed the law, and what it does is that you have two types of taxes that you would have to pay when you do a pre-construction assignment deal. One is that if the closing is after the federal budget day, I don't remember the exact date, but if the closing happened afterwards, you are required to pay HST on the assignment fees. The second part is that the profit that you make net of HST is going to be depending on your intention. It could be considered income, it could be considered capital gain. So it goes back to the particular taxpayer situation.
Okay, awesome. And we have a question here from Sai. So what are the new rules for flippers flipping houses within 12 months?
First of all, the rules are always there. So it's not new rules. It's actually, it has always been around. And there is always that criteria that CRA look at when they determine if a transaction is on the account of its business income or in capital gain. So for flippers out there, your flipping profit, like I mentioned before, because flips are one of those strategies that would allow you to generate income. And typically the sale of the flip itself, if it is incurred in the corporation, you only pay as low as 12.2% tax. If you are doing it in your personal name, then it goes back to your marginal tax rate.
All right. And also on that point, if a flipper uses that right away and does something again, like they just take that into another deal, or they're not really taking it out, they're just putting it right back into another deal. How does it work then?
In that particular situation, it's definitely worthwhile setting up a corporation to own it, because in the corporation, you only pay 12.2% tax, and then the rest of them can all be dumped into your next project. So you're using your very tax efficient, you're investing in your next project in a very tax efficient manner. On the other hand, if you own it in your personal name, you could pay as much as 53.5% tax.
Okay, awesome. And for tax tips, of course, realestatetaxtips.ca. And Chery's the expert there. Silcon asks, suppose someone buys a pre-construction and sell it after closing. Is it considered capital gain or income? I believe you touched on that.
Yeah, so the federal tax federal budget 2022 just changed the rule. And essentially, if you sell it within 12 months of ownership, so 12 you close and you sell it the next day, that's considered income. So 100% is taxable. So if you own it in the corporation, again, it's only taxed at 12.2%.
Okay, and is income versus capital gain based on frequency? So if someone's flipping property often, they're considered income. Is that correct? Or
it's not just based on frequency.
Okay.
Let me just quickly show you the criteria here, because there's a bunch of criteria.
Sure.
So number one is the taxpayer's intention, what you are planning to do. If you always plan to flip it, even if it's just the first one, it makes a difference. How likely are you able to carry out your intention? The zone use of real estate, how much work you've done to carry out your intention. Evidence that you intend to change it after the purchase of real estate. Nature of business. So a real estate agent themselves or a general contractor themselves, if they buy a property, they claim that I'm buying it for long-term rental, but in essence, they use their trades, they do all the renovation, and then they sell it the next day. That's not very good proof that that person is doing it for long-term rental. So these are all the evidence that CRA, the criteria that CRA and prior court cases have looked at to determine one's intention. You can say that my intention is long-term rental, but CRA look at all the rest of the criteria to see if the criteria, the facts around the case is consistent with your stated intention before they make the final conclusion.
Okay, so I would imagine there's a form that the person fills out describing what they did and their intention. And then
there's no form. You file it on your own, and then if they don't like what they see, they come after you.
Okay, interesting.
Yeah.
All right, Rosa asks, hi everybody. If I heard well, rent to own is considered income and taxable at 100%.
Rent to own is a complicated strategy in a way. For those of you who are not familiar with rent to own, in my best way to explain it in simple term is that you're renting out your credit. You're buying a house and then signing a tenant buyer immediately at the time. and the tenant buyer has the option to purchase your property at the end of 2 years or 3 years term, depending on the agreement. Rent to own, it depends on the frequency of transactions. There is no prior court case, but because you immediately sign the agreement that you're going to sell to this person. So many accountants out there are saying that this is showing that your intention is to sell it immediately. And therefore the argument is that it is on business account and 100% is taxable. Now, things do change. Rent to own is not as popular as in the past, and there are many rent to own deals that do not come through as well. So how does CRA really know? Or is it really an argument that, hey, I'm just doing one-off rent to own transaction, can I still report it on capital gain? Absolutely. So it really goes back to your particular situation. For clients who are working on multiple rent to own deals, that's what you would have to worry about.
All right, excellent. We'll take one more question and then we'll get back to it. We have a few more. If Fritchie and Shirley and Robert ask if the corp is a holdco, that is considered passive investing and is 50% tax, correct?
So if the corp is holdco, it depends, again, going back to the essentially to the type of investment strategies you're using. If you are doing flips, it's still active business income. If you're doing land development and sell it to investors, immediately it's considered income. Wholesaling is income. Assignment deals likely is income. So they are all 12.2% tax. But if it is rental income, interest income, loyalty income, as well as dividend income, these are all considered passive income or specified investment business income. In the eyes of CRA, it's being taxed at a passive rate, which is 50%. But out of the 50% you pay, 30% is refundable if you issue and declare a taxable dividend. So it's not just 50% taxable, but there is a refund back eventually. Over the long run, when you get the refund, you pay 20% inside the corporation.
All right, it's good. We got a lot of great questions here, a lot of interaction. So thanks, Chery. Do you have to pay HST for flipping? David asks.
It goes back to your particular situation. So I do have a YouTube video just on flipping. So if you go on YouTube and search Chery Chan or real estate tax tips, there would be my channel would pop up. You can look up that particular YouTube video and it will it has a detailed explanation in terms of whether HST would apply. But it really goes back to the amount of work, because when you do flip, you can like get everything and replace everything, and you can do as little as just doing like paint job and then you resell it. So it's not a fair and easy straight answer.
Okay, makes sense. No one size fits all. Okay, we'll take one more question and we have a Q&A. We'll wait for a little bit at the end. Silkan asks, is the new rules from federal budget 2022, are they in effect or will they be in effect from 2023?
So certain rules are in effect immediately, including the assignment fees, as well as the 1-year rule that they specify if you close the property and sell it within 12 months. Those were in effect immediately.
Okay, excellent. That's all I have for now. Great questions. So thank you everybody for those, and we'll keep going. All right. So Sean, I believe you have some information on. And Chery, anything else you'd like to share regarding capital gains, taxes, strategies? I believe I also have a question here from a previous audience member from beforehand. So how does a vendor take back affect capital gains taxes in the perspective of a landlord or potential seller of a property?
I'm going to take this question and then we will talk to Sean after this too. Okay. And so when you do vendor take back mortgage, you are allowed to spread your capital gain over the 5-year period based on a formula. Now, just because you take a vendor take back mortgage, it does not mean that you just automatically take your capital gain and divide by 5. It's really based on the amount of vendor take back mortgage that you take. So it's a percentage of that based on that and how much you are still owe as a seller by the end of each year. So sometimes in some situation, you can delay 40% of the gain because the loan represents certain amount of your full sale price. So you can delay it. There may be benefit, especially for people who own their real estate in their personal name. But if they own the real estate in the corporation, there may not be any tax benefit because in the corporation, you pay the same amount of tax, whether you pay it in current year or over the next 5 years. Now, I personally think that as a real estate investor, accepting vendor take back mortgage as a seller is a negotiation chip. You can, I'm sure actually Sam can talk to it a lot better because I'm not a negotiating expert. Sam is. So if you're negotiating that deal, if you want a higher price, you're willing to do the, typically they're willing to the seller are willing to can ask for a higher price in exchange for the vendor take back mortgage because that's better financing for the buyer. So correct me if I'm wrong, Sam.
Yeah, that's absolutely correct. Yeah, I mean, it does help because if the property is underperforming from a numbers perspective, we do have a property analyzer, so we'll throw our schedule in the chat if you do have questions. Yeah, it will help negotiate a better price for the seller. And if the seller doesn't mind holding a little bit of the mortgage for whatever their circumstances, it will definitely help the property perform a little bit better and cash flow a little bit better than it would if it was no vendor take back, for sure.
Mm-hmm.
Okay, so we have here, Rafi asks, are you able to hold long-term rentals and flips in the same corporation?
Yes, you can do whatever you want in the corporation. The only thing is, I'm sure Sean can give her his opinion on it as well. From a tax perspective, you're allowed to hold everything in the corporation. The only caveat is that you may not be able to claim capital cost allowance against your rental income. Sean?
These are two very different real estate investing strategies. So I generally advise my clients to separate their types of income by corporation. So, if I have a client who's buying and holding or burring properties and also flipping properties, then I am generally recommending that they do the burring in one corp or a series of corps, which for all of you who are tuning in today, this is an advanced strategy. Don't necessarily just jump into multiple corporations. Make sure you get good tax and legal advice before you do that. But on the other side, I also recommend that if they're going to flip as well, that they do that in a separate corporation. And the reason that is, there's two reasons. One is tax related in that it makes it a lot easier for your accountant to separate the active income from the passive income because those two types of incomes are treated very differently. And so it makes your bookkeeper and your accountant's life a lot easier. But the legal reason, the other reason that I recommend this strategy is because I want you to envision each property, in fact, each door, right? If you're buying multi-res, each door is itself a mini business. And each mini business comes with its own set of risks. And as you multiply the doors or you exponentially grow and you accumulate doors, you are accumulating risk. So the more doors you jam into one corporation, the more likely it is that something could happen that allows your creditor or whoever you've caused potentially damage to reach up and grab whatever you own. So, and especially when we're talking about flipping, which is a much more higher risk activity than burring and long-term buy and holds, we really want to isolate the construction risk, the insurance risk, the damage, like the physical damage risk of flipping from our buy and holds. Because ultimately we want to make sure that our assets are isolated so that these people who we potentially cause damage to or could be sued by can't go and start claiming against other assets. So let me just bring my...
And yeah, for our audience too, BRRRR, just buy, renovate, refinance, rent. So buying and making an improvement on the property, then you're going to refinance it and pull it out and keep 20% in the property. And you've ideally lifted the value of the property after your renovation. So,
okay. Why don't we move to,
Yeah, let's.
assuming
we
we've
have
made
10
the decision to sell.
Yeah, absolutely. Go ahead.
So, Sam, I think you and I could probably talk a little bit about the effect of tenants.
Yes.
You from the buyer and seller perspective and a negotiation perspective, and I'll talk a little bit about the legal consequences of various scenarios. So, generally, and Sam, I'm sure you'll agree with me that as a buyer, as a real estate investor buying either a single family or a small multi or even a large multi, you're looking for vacant possession. Unless you're getting into the very large commercial multifamily where you're truly relying on the real true power and strength of that net operating income in order to support your financing. If you're and I know many of the people on this call, and a lot of us are in the small multi range where vacant possession would be quite advantageous, so that we could get in and turn the units, make sure we rent it at market rents, and then refinance at a really high net operating income, get the best valuation possible. So generally, and I'm sure Sam, and maybe you can speak to this, it is advantageous for buyers to negotiate for vacant possession.
Yeah, absolutely. We've seen, and again, I'm not a paralegal. Usually we refer them to someone like yourself as well. And our concierge, which has professionals like you as well, Sean. In regards to N12 and 11, it's time to sign the declaration. They're going to be moving in there. It's a different form. And 11, the cash for keys, all that stuff. Having something in place so that buyer who's purchasing or making an offer already has something in place. I know there's a whole bunch of guidelines around a corporation and all those other things, which you guys can maybe touch on. Generally, though, yeah, it's much more advantageous to have that, having less risk for that buyer, knowing that it will be vacant possession, because not everybody. There is a clause that we do have. However, it's not as strong as like actually getting the N11 thing. So if the tenant decides not to leave, there's a whole bunch of other things that having those forms, I'm sure, would help. And Sean, if you could touch base a little bit on the N11, N12, and what someone could do if they're selling their property, they should know of when they're getting involved in getting on the market and ideally getting it sold.
Yeah, sure. That's precisely what I was getting at. We're talking really here from the perspective of the seller. And so as a seller, first of all, if you are going to consider giving vacant possession, you should be asking for a higher price. That, just like the VTB, is a negotiation tactic for you. And, I'm sure Sam would agree with me, and frankly, Chery will too, because we know buyers want vacant possession, especially in this province, where it's such a challenge to turn tenants and to get rents up to market value. Vacant possession is worth a lot. And so, as a seller, you're going to want to consider that if you're going to give vacant possession, you're going to want to build in an extra, more in terms of purchase price. And that's because you are likely going to have to spend some to make this work. So there are two primary ways for legally getting to vacant possession. So let's start with the basics. Leases pass with the land. That is a legal tenet that basically means if a person has a leasehold interest in a property or a unit in a property, and Sam, if you were my landlord and I signed a lease with you, I now have a leasehold interest in your property. Okay? So if you sell your property, my leasehold interest stays. You can't affect legally my leasehold interest. So leases pass with the land. This is why it's important that we set out in the Schedule A of the Agreement of Purchase and Sale whether or not we are expecting or negotiating for or have agreed to vacant possession. Because absent a statement clearly setting that out, a buyer is going to be assuming the tenant. So, that's really the basis for why we need to have the discussion of how to ensure vacant possession. So there are two primary ways, as I mentioned. The first is fact specific. What I mean by that is if your buyer is planning on moving in, then that is a very fact specific scenario. It's going to be specific to each individual buyer. And let's start there. If we're talking about a single family or a duplex, and I think up to a triplex, then the buyer of the property can tell the seller that I'm going to take possession of one of the units if it's a duplex or triplex, or the whole house if it's a single family. And the seller, if the sellers agree to give vacant possession, will then be under an obligation to serve the N12 form. The N12 form's got to be filled out properly. In particular, there is a section on there that says, I, the landlord, have sold the property and the buyer intends to move in.
Selling your home during tough times, whether you're downsizing, divorce, or debt, we understand the unique challenges you're facing. Introducing our specialized real estate solution to help you navigate these difficult times with ease. Selling a home can be overwhelming, and yet our experiencer team will guide you through the process, providing personalized strategies to maximize your home's value. Whether you're downsizing, going through a divorce, facing debt, we'll help you sell your home and start anew. Don't let these challenges define your selling experience. Let us turn them into opportunities. Visit our website at affluenceregroup.com to learn more.
There's not really a discretionary piece to this, so I don't want to spend too much time on it. If you truly do intend to move in, you will be required to swear an affidavit to that effect. And of course, if it's false, then that's going to be problematic for you. You will be required to move in on closing or shortly thereafter. And the sellers just got to basically go through the motions. And the motions are a certain amount of notice, a certain amount of compensation, and a certain proceeding at the landlord-tenant board. But there's no discretion in this decision, absent evidence that you're not going to move in. Now, you may consider fabricating the idea that you might be moving in. And I would, encourage anyone who considers that strategy to reconsider. Yes, we want vacant possession. And yes, because the N12 is so powerful, it might seem like an easy solution. But, purging yourself in a statutory declaration or affidavit is really not advisable. That is potentially criminal conduct. And, I can tell you that's likely not worth it. There are other avenues to get vacant possession. Now, before we get there, if you're a seller and your buyer tells you that they're moving in, and then they give you an affidavit saying as much, you can rely on that. But if you're working with a realtor like Sam, you want to make sure that your realtor and the buyer's realtor have some good conversations about this to make sure that this is legitimate. Because if the buyer is lying and the tenant finds out, and believe me, the tenants are monitoring. The tenants do not like moving. And so if they discover that they moved under fraudulent or false pretenses, you can bet you're going to find out about it and you're going to hear about it. And that will mean unnecessarily being dragged into litigation. Now, you will likely not be liable because you relied on an affidavit, which you are entitled to rely on. But nevertheless, you'll be dragged in anyways, and you'll have to hire litigation counsel and get yourself out of that lawsuit. So not ideal. Make sure that if you're to serve an N12, that you're prepared to sign it.
So Sean, if someone, and this happens often, let's say N12 is signed, declaration signed, closing date June 1st, given the notice, everything was all right. What's the way to make sure that that tenant would be out by the time that that new person who's living in there is going to be, it's closing, it's going to be vacant for that person? And what happens if the tenant does not move out? What happens after that point as far as getting the tenant out of there if it's legitimate and they require vacant possession?
Well, obviously, this is not an ideal scenario.
No.
So, first of all, you've got to have properly filed the N12, right? And the extent of that proceeding, I don't know the full extent of that proceeding. That would typically be our paralegal at our office that would assist on that matter. But in essence, what you do need is an eviction order. So if you have that eviction order, then you can have the sheriff help you. And that may require calling the sheriff the day before closing to make sure that they show up and see the tenant out.
So the existing seller who's sold firm and almost closing, they can do this, they can do the sheriff, or does it have to be waiting till possession changes and then?
No, here's the thing, the buyer's not going to close without it.
Absolutely.
Right. Well, they might choose to accept the breach of contract and then sue the seller for whatever cost they incur trying to get the tenant out. But if you're the buyer, you have all the leverage. So, you might say, yeah, sure, I'll do that for a $10,000 price decrease, or no, and I'm not going to give you an extension, and I'm ready, willing, and able to close. And if you don't close, then I'll sue you as well. So, not ideal. Here's a strategy. Before you sign anything, any agreement of purchase and sale, and you are going to give vacant possession, I would highly recommend that you speak to a lawyer or a paralegal that practices landlord-tenant law in the area in which your property is located, and get a sense of how long the N12 is going to take to get an eviction order. And that will give you a sense about how long you need to make closing. Because you do not want to, set a 30-day closing, get ready to cash that check, and then realize, well, your tenant is not going to be out, because that's going to put you in breach.
Gotcha. So we also have, I guess, a lot of questions around N11. I know that's the cash for keys.
Yeah, that's the
thing. So you can discuss that a little bit, Sean.
Yeah, that's the real juicy strategy, and it's tenants are becoming aware of it, but lots of tenants are fine with it. And what the N11 is really a settlement. It's an agreement. Now, in law, a contract or an agreement requires three things: offer, acceptance, consideration. I mean, the first two are obvious, right? I make an offer to you, saying you accept it. We've got those two things. The consideration is the thing of value transferring at the time the contract closes. So what I want you to consider is that an N11 has got to have some consideration. Now, obviously, as the seller, if you're doing an N11, the consideration for you is vacant possession. But the tenant needs consideration too. And so what it ultimately is a settlement of the lease. It's basically the N11 is a termination of the lease, but the tenant is going to want consideration. And this is where the term cash for keys comes. So you have an N11 signed saying, I will pay you $5,000 if you'll agree to terminate the lease as of this date and move out. Okay, if you can come to an agreement with your tenant on move out date and price, make sure that N11 is filled out properly, that it's filed properly, and that's a great first step, but it's not over there. Here's the thing. Some tenants are going to be great about it, right? You're going to show up there on the day of closing with $5,000 in cash. They're going to hand you the keys. You're going to hand them the cash. And we've got our traditional cash for keys transaction, right? They're out, you're in, and fantastic. But tenants have started to figure this out, and they know the landlord tenant board takes so long to resolve anything that they could theoretically, if you paid them in advance or actually gave them good faith money they just take it and stay. And so if you're considering the cash for keys strategy, I want you to consider this. Put the money into your lawyer's trust account with instructions that say you're to release funds upon proof the tenant has moved out. And the tenant can submit the proof directly. Of course, you as the client would need to confirm it. But make this arrangement. In fact, it's almost like betting on the result, right? Sure, we agree $5,000. Okay, I'm going to put that $5,000 into my lawyer's trust account, and I've instructed them by way of an irrevocable direction, which literally says, the lawyer can rely on it, that you can't revoke it. And what it'll say is, upon receiving proof that this person has moved out, send this money to this person. That is a very good way to make sure that your tenant actually moves out and gives your tenant some confidence that they'll actually receive funds. And this is a strategy I don't often see employed, but for all you sellers out there that are going to give vacant possession, consider this, because you do not want to give your tenant a cent, because once you do, you lose all your leverage, and they have all the power because the landlord tenant board is going to take 12 months to get them up, and they'll probably stop paying rent. So at that point, I would say set the terms so that your lawyer holds the funds and those funds get released on proof that the tenant has moved out.
Great. That's some great tactical advice, Sean. I think for every seller who's considering downsizing their portfolio or reinvesting in something else, I think that's something they should definitely consider. So we have, and I know there are different situations if you have a corporation and all these things. So if you have questions, we're going to make sure everybody who's registered for this webinar will get a copy of your schedules to book a call. And what we're also going to do is the first 5 people who do book a call with us, we're going to give a copy of Chery Chen's book to them. So real estate investing tips. You didn't know that,
Absolutely.
Chery?
I'm happy to send it to them directly. Don't worry.
All right.
Thank
Well,
you.
it's on
a
me.
surprise.
It's on me. So it's all good. It's all good. Karim asks, if you move an investment property from personal name into corporation, do you have to pay capital gains on top of land transfer tax?
Great question. I also do have a YouTube video on it. If you want detailed explanation, the high level explanation is that you do have the option to file a tax deferral form to defer the capital gain tax, assuming that you have not refinanced the properties too many times. You should not have to pay any income tax on the transfer of the property to the corporation. However, you also need to pay attention to the hidden costs that people don't normally think about. There's the accountant fee to fill out the form, to write the instruction letter to the lawyer. There's Sean's fee. Sean also needs to charge as well to do the closing, to do the title transfer. And then there's also a mortgage penalty. When you transfer the asset to the corporation, you need to get your bank's approval. So there could be some mortgage penalty involved as well. So those are some fees that people do not usually overlook.
That's a great point. Yeah. And at that point, if you were in contact with us, we'd get you in touch with a qualified mortgage broker about the penalty and looking into your situation. Karim also asks, if you have multiple corporations, can you later on set up a holding corp owns all these corporations? If yes, does that count as change of ownership and triggers any taxes, capital gains, ? So that's what we have there.
So the easy answer is that you can't really just simply transfer the shares. I think Sean knows a lot as well. You can't just transfer the asset, your shares from one property to another. You really need to do also something called rollover, which can get really complicated to do the rollover of shares. You need to get Sean involved and then get an accountant involved as well to do a valuation of your business, your whole portfolio, and then transfer it to your new holdco. So the easiest way is to set up the proper structure from the beginning to do that after, so then you can avoid doing that after.
Okay, excellent. Haiti asks, if you're doing a refinance, is that the best time to move from personal to corp? Good question.
Sean, you want to speak from an investor perspective?
Sure. Except, Haiti, I don't know that there's a good answer to this without further context, because what I want to ask you is why are you transferring title, right? Are you doing it for legal liability reasons and you don't care about the tax implications? Then yes, that's a great time to do it, because the name on title to the property must also match the name of the mortgage holder. So if you're going to refinance, that means that one mortgage is coming off and a new mortgage is going on. So the new mortgage would be in the name of the corporation, right? If you want to change the title holder's name and you have a mortgage on the title, you have to refinance or get your lender to agree to let your corporation assume the mortgage. But good luck with that. That's not a viable strategy. It's very, very rare that's deemed acceptable. And there's very good reason. And it's because, unless you're in the interest only space, but if you're in conventional financing, the lender wants you to refinance. And if you've ever looked at an amortization schedule, you'll figure out why. And that's because when you restart an amortization period, the lender is making the absolute highest return on their money. In fact, we can go searching for months for the lowest rate, but the lowest mortgage rate's irrelevant when the effective rate in the first 5 years is going to be 40 or 45%. And so keep that in mind. But that's not to say refinancing is not a great strategy. It just means that the bank's never going to let you have the mortgage assumed because they want to make more off of you. So yes, if you're going to move from personal to a corp, you're going to want to time it with a refinance as a matter of necessity. Now, from a tax point of view, if you've got tax considerations, or if you want to do this for tax reason, then you really need to book a time with Chery, because you've probably, and like all of us, have been listening to Bigger Pockets and a lot of American media about the great tax benefits of owning real estate in a corporation. Well, it may not be what it's cracked up to be in this country. So, Chery and her team are the people to talk to in respect of making sure that that's the right tax move. And as we've been talking about, this is a really holistic. You got to make a holistic decision. You got to decide what's more important for you, or what's going to win out. Like, is it dollars and cents? Is it taxes, or is it I want to sleep at night? And maybe it's a bit of both, but sometimes they're going to work in diverging ways. And so it's really important to speak to your tax advisor, to speak to your lawyer. And I also advise people to speak to their mortgage broker, because corporate borrowing is it's different. It's a much different ball game, if you might. So it's important that you get a sense of the whole picture, right? The tax, the borrowing, and the legal side of it before you make any decisions.
One
Okay,
thing I
great
do
answer.
want to add to it is that the insurance. So people think that it's not important to own them in the corporation. I mean, we are one of our clients' register office. We receive a letter from a lawyer accidentally on behalf of our clients, essentially suing our client on slip and fall in the rental property. So things that would happen that you think it's only happened in the news that wouldn't happen to you, it could happen to you. So legal protection is something that people should pay attention to for sure.
Excellent. Great question, Haiti. So I believe we have a couple Q&As and then we'll wrap things up. This is incredible tactical information today for anybody who's an investor or interested in learning more about capital gains, investment property, and how that affects them. Karim, I believe, said here, personal name to corporation, do you pay cap? I believe we answered that one. SP said, can you clarify on the HST implications on assignment with the new budget, i.e. HST on the purchase price or sale price on assignment? So I believe that is a different question we've seen.
So yes, absolutely. So this is a complicated subject on its own. Even in the past, it is pretty complicated. Essentially, when you are buying a pre-construction condo, you pay the deposit to the builder. And it could be like up to like whatever amounts, usually up to 5%. You pay 100,000 in, let's use an example. You pay $100,000 to the seller. Now that the condo may be worth, the pre-construction condo could be worth $200,000 more. Now, technically, you're supposed to, as the owner of this contract, the condo hasn't been built. Now you want to assign it to someone else and make profit on that increase in appreciation, the $200,000. CLA is saying that you are required to charge HST on the assignment fees. So is it on $200,000 or on the full sale price? Because now it could be something completely different. In the past, CLA has taken a really aggressive position that the HST should be applied on the $200,000 as well as the $100,000 deposit. So even though the deposit is just to reimburse you, the reality is that CLA also want HST on that. Now the budget hasn't really clarified it for us. And there was prior court case that says the court actually sided with the taxpayer that the HST should only be as charged on the spread, which is the $200,000. CLA took the position that it should be $300,000. HST should be charged on the $300,000. And there are belief and rumors on the street that HST should be charged on the entire sale price, which is even worse than charging it on the $300,000. So they haven't come out to clarify it yet. My belief is that it should always be only charged on the assignment spread, which is what is fair. So we don't know what it is. And typically, to be honest, we generally advise the clients do not sell their assignment. Try not to sell on assignment deals if they can afford to keep it and afford to get financing, and try to keep it for a minimum of 1 year, if not longer, for rental properties to avoid any negative tax implication. It's not as good as it sounds. You don't make the $200,000 because you have to pay HST, you have to treat it as income, and then it gets more complicated from there.
Right. That's a great point, Chery. So we have an anonymous attendee here, Sean. I guess Sean. Sean, Airbnb arbitrage is becoming popular. What is the best legal setup if you're running Airbnb arbitrage company that is scaling? Right now, I have 2 properties on a personal lease. I would like to scale and protect myself. What type of legal structure would you recommend?
Great question. So remember we talked a little bit earlier about leasehold interests. So as an arbitrage company operator, you need a leasehold interest in a property in order to be able to arbitrage that property. So it sounds like you have 2 leases where you are personally named as the tenant and are basically re-renting the properties or the units or the rooms out to make the spread. So great strategy. But ultimately, from both a legal and a tax perspective, you may want to consider incorporating and doing a couple of things. So number one, you're actually probably going to want 2 corporations, one to own the corporation that's actually active and that's doing the arbitrage. And that's an advanced tax strategy that you can speak to Chery about later on. But the reason you're going to want a corporation to be the tenant, the original tenant under the lease, is because you're operating a business with a high churn rate. More churn, more liability. So your corporation is a separate entity under the law. It lives and breathes in a legal sense, and so one of the principles of contract law and litigation about contracts is that only a party to a contract can sue or be sued in it. So if you are turning tenants and you have issues with either the tenants or, on the other side, the landlord, you don't want to be personally sued because then, if you lose, all of your personal assets are at stake. It's the problem. So what you really want to be doing is making sure that your corporation is a party to these contracts, right? Party to the lease with the landlord, and then as the sub-lessor down to whoever you're arbitraging to. And this is beneficial for a couple of reasons. You're personally protected, right? Absent malfeasance or fraud of some sort, but that's getting into the weeds. If you just simply performed a contract or failed to, or caused damage to someone, then your corporation will be sued, not you, which is great, because your corporation is otherwise worthless. And remember how I said you want to own that corporation in another corporation? And the reason that is because every month or every week or every quarter, you can send money up the chain to your parent company tax-free. It's called an intercompany dividend transfer. It's a great way to keep your company worthless, right? So it just simply exists to accept the liability and to earn the revenue. It makes your company worthless. So if you ever do get sued, number one rule of litigation is only sue someone with money. And if your company has $0 in the bank account and owns 0 assets, then there's not much to sue for. And even if they do go to litigation, and even if then they win, it's a Pyrrhic victory, because your company will just go bankrupt, and then you'll just enter into a new lease and move on.
All right, that's a great answer. And I think that's the importance of Sean, who does have an understanding of investing in real estate as well, and does it himself too. So in the legal aspect. And so that wraps up our webinar today. Really appreciate everybody who's joined us. What we're going to do is send a copy of everybody's schedule to everybody who's registered for the webinar, or you can share the link as well. The first 5 people also get Chery's awesome book on real estate tax tips, I believe it's called. Thank you everybody for joining today, and we trust you got some value.
Thank you so much for having me.
Thank you.
Thank you so much, man.
Thanks again, guys.